Now, let's look at markets and investing. We go back to the financial speedometers that are put out by City National Rockdale and the equity market conditions. These are only 3 of the 20 speedometers that we look at for the economic indicators, but the reality is these are the 3 important ones right now. Why do I say that? Well, your fear indicator, which indicates, whether people are exuberant in the market or fearful in the market. Again, that indicator is a contrary indicator. What does that mean? It means that the more red it gets, the more exuberant people get about the market. The more green it gets, the more fearful people are, and the more likely that there's going to be a pullback. So we are looking at this. If you look at the valuations, again, valuations actually crept up this week. So it's going the wrong direction, but we'll see what happens as we move forward. I mentioned earlier on that interest rates are near 0% after the 40-year decline. So most people don't understand this decline's been going on for quite some time, and we're quite close to 0 because of what's going on with the COVID crisis and the spending. But there is something that is a silver lining to that, and that is this. Whenever the Treasury is low, most come out of Treasuries because the investment isn't giving them what they need to produce. A lot of that money tends to go into the stock market, and it tends to go into stock markets that people trust, and the U.S. market is that #1 market. So as you can see, long term, it looks like that the ability to ride a bull market is certainly trending that direction for us. So when you're looking at returns, and I'm looking at this balanced portfolio that people historically have used, 40% bonds, 60% equities, you can see the chart below it that it produced a reasonable return over time. Now, I do want to note the returns that we're showing here are gross returns, meaning that there's no expenses associated with it. There's no fees associated with it. So it is a gross return. You can't get gross returns out of the market because there's always expenses associated with it. But still impressive numbers. Now, here's the problem. If we look forward and we're looking at corporate bond returns, and we've talked about this many times, in the past, they've just worked very, very, very well. However, what are they projecting moving forward? Well, they're projecting a current yield on corporate bonds of about 2%. Well, look at just the 10-year return. It used to be 5, now it goes down to 2. That is a considerable drop in income for people who are focused on income out of the dividends in a bond portfolio. So what is that person to do? Well, at the end of the day, the traditional 60-40 portfolio isn't going to work like it did in the past. So we've got to make some changes. And this is where moving from, let's say, a 60-40 portfolio to a 70-30 portfolio, and then tactically adding in dividend stocks, in dividend stock portfolios, high yield stocks, you can actually pick up some additional return to make up what you lost. Now, that does require what? It requires a little bit of risk. So when you look at this chart here, this chart is effectively showing the daily, quarterly, 1-year, 5-year, 10-year, and 20-year positive returns versus the negative returns. And what you can see also is the longer you're in a portfolio, the less likely you're going to have the negative aspect. And so it's all about time horizon. But when you think about time horizon, most of our clients think long term. They think generationally as well. So, you don't have just a 5-year horizon. You've got a 10, 15, 20, depending on how long you're going to live, how long your heirs are going to live if you're really legacy minded, the longer term makes a whole lot more sense when it comes to investing, and you end up with much higher returns. So let's go on and look at adding a uncorrelated alternative. Now, this is something we do a lot with our clients. So our clients are very familiar with this. If you moved from the 60-40 portfolio, the traditional, and then shifted again, using in the stock market, the stocks with high dividend yield and reducing the bonds and adding life cash value, you can make a significant difference in your returns, plus add additional strategy options down the road, as our clients have right now. So if you think about it, if you add that cash value to the portfolio in a indexed universal life program, you don't add additional risk, you actually reduce the risk. So your standard deviation actually lowers on that portfolio, even though you might have added additional risk relative to the stocks. The overall risk reduces down. Think of it this way from a return standpoint. On this chart, it shows you returns for a different asset classes from 2009 to 2019 and what the future long-term forecast is. So your high dividend stocks, emerging markets, high yield bonds, alternatives, all of them are looking to get reduced because of the way the economy is changing, the market and such. So your long-term forecast has gone down as well. However, one of the categories that has reduced the least is the IUL cash value, that bond alternative that we use for our clients. Again, reduces the risk, but peppers in a higher rate of return. So the portfolio works better. And might I add, also, it adds options for markets that allow us to actually reduce the client's risk even further with the additional strategies like the draw and let heal strategy that we are implementing right now with our clients. So big deal. It's a way to move forward without the additional risk. That's why tactical investing and wealth management is so important, to make sure that you're getting the most you can out of your money. When you're looking at the market, it's interesting right now. The market's actually looking past 2020 earnings into next year. Why? You know, they kind of look at this year as a lost year, but they haven't fully priced in what's going to be happening from an earnings standpoint. So the way this chart works here, you've got on the left side 2019 actual, and then 2020 and 2021 estimates. You got the S&P earnings per share, and then you got the price earnings multiple. Well, how does this work out to get the implied value of the S&P 500? Well, you multiply, let's say, the 2019 163 number times 20, and that equals out to be your 3231. You go to the estimate for 2020. Well, you can see that the earnings per share is significantly lower. So when you multiply it by the price earnings multiple of 20, you can see where the S&P really should be right now. And that's why most institutional money managers, most economists believe that the market is going to take a correction here sometime soon, relatively soon. And that is the time that we're looking at actually initiating many of the strategies we've got set up right now. So looking at the price earnings ratio, where are we at this point? Well, we've creeped back up again a little bit. The current number is at 22.23. Last week it was in the 21 range. That's because we had a bit of a dip. And it started coming back again over the last 3 days. So it's moving the wrong direction for the institutional money managers to want to get in. So where are we today? Well, here's the graph again. When you're looking at this graph, and let me kind of point something out here. When you're looking at this graph, these dots really indicate where the market is leaning. When the dots are on the top of this chart, it means the market is kind of pushing to the negative side. When it's on the bottom side of it, it's pushing to the top side. As you can see, there's been a little more weakness in the market. We haven't seen this much so far in this recovery. We do expect it to happen again. It could very well happen when we have, again, a multitude of events that occur that push it down, kind of like we've been talking about earnings season and how the news is portraying the recovery from COVID. So big deal right there. It lets us kind of see what's going on. Again, the markets are looking at and for a healthy correction of 10 to 15%. That drops us into the blue zone, which is actually, kind of highlights part of the optimal zone, that green zone, when it comes to executing our strategies. So we're ready for it. We're just waiting for the numbers to prove it out right now. So we are moving forward, but there are signs of weakness in the economy. So we will keep an eye on it as we continue to move forward.